studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Schedule 11 is designed to disclose financial transactions that take place between a corporation and the people who are closely connected to it. These include shareholders, corporate officers such as directors or executives, and employees. The reason this schedule exists is simple. Transactions between a corporation and its owners or key individuals are not always conducted at arm's length. Because of this, the Canada Revenue Agency pays close attention to these transactions to ensure they are properly reported and that any tax consequences are correctly recognized. Think about all the ways money can move between a corporation and its key people. A shareholder may borrow money from the corporation. An officer may receive a salary or bonus. An employee may receive an advance for business expenses or a taxable benefit such as the personal use of a company vehicle. In some cases, the corporation may even pay personal expenses on behalf of a shareholder or officer. These are exactly the kinds of transactions that Schedule 11 is designed to disclose. It's important to understand that Schedule 11 is primarily a disclosure schedule. It does not calculate the corporation's tax. Instead, it provides the CRA with information about transactions that may require further review under other provisions of the Income Tax Act. That doesn't mean every transaction reported on Schedule 11 creates additional tax. Many transactions are completely legitimate and have no adverse tax consequences. However, the CRA still expects these transactions to be reported accurately so that it has a clear picture of the financial relationship between the corporation and the individuals connected to it. The key takeaway is straightforward. Whenever money, benefits, loans, or other financial transactions occur between a corporation and its shareholders, officers, or employees, ask yourself whether the transaction should be disclosed on Schedule 11. Good disclosure promotes transparency, supports accurate tax reporting, and helps reduce the risk of questions during a CRA review or audit. Schedule 11 covers a wide variety of financial transactions between a corporation and its shareholders, officers, and employees. Understanding these transaction types will help you recognize when disclosure may be required. One of the most important categories is shareholder loans. This occurs when a corporation lends money to a shareholder or when there is an outstanding amount owed between the shareholder and the corporation. Because shareholder loans can have significant tax consequences, they are one of the areas that the CRA examines most carefully. Another common category is salaries and wages. These include regular payroll, bonuses, commissions, and other forms of compensation paid to officers and employees. While these payments are often reported elsewhere, they may still be relevant when reviewing transactions between the corporation and its key individuals. Schedule 11 also includes taxable benefits. Examples include the personal use of a company vehicle, employer-provided housing, certain travel benefits, or other personal benefits paid for by the corporation. These benefits may have personal tax consequences and therefore require proper reporting. Expense reimbursements are another common transaction. If an employee, officer, or shareholder incurs a legitimate business expense and the corporation reimburses them, that reimbursement should be properly documented. Similarly, advances provided before business expenses are incurred should also be tracked and supported by appropriate records. Finally, there may be other financial transactions, such as payments, transfers, or agreements between the corporation and its shareholders, officers, or employees that should be disclosed depending on the circumstances. A helpful way to think about Schedule 11 is to imagine money flowing between the corporation and the people connected to it. Whenever money or benefits move in either direction, ask whether the transaction needs to be reported. It's also important to understand the CRA's areas of focus: shareholder loans, personal expenses paid by the corporation, and undocumented benefits frequently receive additional attention during reviews and audits. Good documentation can prevent many future problems. The key takeaway is simple. Not every transaction creates additional tax, but many transactions still require disclosure. Accurate reporting and proper documentation demonstrate transparency and help ensure the corporation remains compliant with CRA requirements. Completing Schedule 11 begins with a careful review of the corporation's accounting records. Before filling in the schedule, you need to identify every financial transaction involving shareholders, officers, and employees that may require disclosure. A good starting point is the general ledger. Review shareholder loan accounts, payroll records, expense reimbursements, employee advances, and any accounts that involve benefits or payments to individuals connected with the corporation. As you review the records, ask the right questions. Did the corporation lend money to a shareholder? Were any personal expenses paid by the corporation? Did an officer receive the personal use of a company vehicle? Were employee advances properly cleared and supported with receipts? These questions help ensure that no reportable transactions are overlooked. Once you've identified the transactions, gather the supporting documentation. This may include loan agreements, payroll records, receipts, reimbursement claims, benefit calculations, board resolutions, or any other documents that explain the transaction. Strong documentation is essential because it supports the information reported on Schedule 11 and provides evidence if the CRA requests additional details. Next, complete Schedule 11 using the information you've collected. After the schedule is prepared, retain all supporting documentation with the corporation's records. Even after the tax return is filed, these documents may be needed during a future CRA review or audit. There are several common mistakes to avoid. Don't ignore shareholder loans simply because they involve the owner. Never record personal expenses as business expenses. Make sure taxable benefits are properly identified and reported, and avoid relying on incomplete or missing documentation. These are some of the areas that frequently attract CRA attention. Before filing the return, complete one final review. Confirm that you've examined all shareholder transactions, identified officer benefits and employee advances, gathered supporting documents, and accurately completed Schedule 11. The most important takeaway is that good documentation protects everyone involved. It protects the corporation, supports the shareholder and employees, and demonstrates that transactions have been recorded honestly and transparently. Careful record keeping today can prevent costly questions, reassessments, and disputes in the future.